Welcome back to the Deep Dive. It is Friday, February 13th, 2026. And I want you to start this deep dive by doing something a little different. I want you to look around the room you're sitting in right now.
Okay.
Maybe you are in your home office, maybe you are in your living room, or maybe you are commuting and looking at the car dashboard. Look at the building itself. Look at the art on the wall. Look at that bottle of whiskey on the shelf, or hopefully not if you are in the car.
Please keep your eyes on the road if you are driving.
Right, please. But look at those things. For the last century, practically for all of human history, those objects were what economists call dead capital.
Dead capital.
Right. They sat there, they were valuable. Sure, a house is worth money, a painting is worth money, but they were frozen. You couldn't spend your house at the grocery store. You couldn't trade a sliver of your office building for a share of a vintage Ferrari on a Tuesday afternoon.
Exactly. They were islands of value, completely cut off from the flowing river of global finance. You own them, but you couldn't really use their value without selling the whole thing.
But if you have been reading the financial headlines over the last 18 months, you know that the ice is melting. We are witnessing a shift that some people are calling the financialization of everything.
It's a huge term, but it's accurate.
We aren't just talking about Bitcoin or internet money anymore. We are talking about the fact that the bricks in your wall are starting to behave like stocks on a screen.
The convergence is finally here. The physical world is shaking hands with the digital one. And the numbers really back that up. I was looking at the stack regarding the RWA market real-world assets.
RWA, yeah.
Back in 2022, this was a cute $5 billion experiment, a niche corner of a niche market.
A curiosity.
A total curiosity. Today, in early 2026, we are closing in on $36 billion.
Wow. Okay, so that is a quintupling, more than a quintupling of the market in a very short window. That's not a trend, that's an explosion.
It's an inflection point.
So our mission for this deep dive is to figure out how. How do you turn a skyscraper into a token? Why are titans like BlackRock and JP Morgan suddenly obsessed with this? And perhaps most importantly, should we be doing this? Is this actually useful, or are we just inventing new ways to gamble on things we used to simply enjoy?
It's the multi-trillion-dollar question, isn't it?
Yeah.
And to answer it, we have to peel back the layers of hype and look at the actual machinery.
The plumbing. So let's start at the very beginning. Real-world asset tokenization. It sounds like a buzzword salad you'd hear at a tech conference that costs too much to attend. What are we actually talking about here?
It does sound complex, but the concept is actually quite elegant when you break it down.
Think of it as a digital twin.
A digital twin.
Tokenization is the process of creating a unique digital token on a blockchain that represents ownership or specific rights in a real, tangible asset. It's a digital representation of a claim on something in the real world. Okay, stop there, because I can hear the skeptics already. We have had digital records for decades. My bank account is digital. My stock portfolio is digital. Why do we need a token on a blockchain? Is this just a receipt with extra steps?
That is a fair challenge, and it's probably the most common first question. Yes, you have a digital record at your bank, but that record lives in a silo.
A walled garden.
A walled garden, exactly. It lives on the bank's private server. It's a line in their database. Yeah. If you want to move that value to a different bank or to a different country or sell it to someone on a Sunday, you hit friction. You hit business days, you hit wire fees, you hit international transfer limits.
The fax machine era of finance, as they say.
Precisely. Tokenization changes the nature of the receipt. It makes the receipt programmable and portable. It acts as a digital vault that can move. You take something valuable, a house, a gold bar, a copyright, and you represent it as tokens. This shifts us from a world of paper deeds and settlement periods that take weeks.
T+2 if you're lucky.
If you're lucky. And it moves us to a global market that settles in seconds via smart contracts.
So it's the difference between sending a letter via the post office and sending an email. One is physical and slow, the other is digital and instant.
I take it even further. It's the difference between sending a letter and sending a self-driving car that knows exactly where to go, who to let in, and how to pay for its own gas along the way.
Okay, I like that. That's a powerful analogy. But let's play devil's advocate. Why do this? We've had stock markets for a long time. We can buy REITs, real estate investment trusts, if we want exposure to real estate. Why do we need to tokenize the actual assets? What's the new value here?
That's the core of it. And there are really three main pillars of value that the research consistently highlights. The first, and the one that gets the most marketing budget, is fractional ownership.
Right, the ability to buy a slice of the cake instead of the whole thing.
Imagine a trophy asset, a skyscraper in Manhattan. a vintage 1962 Ferrari GTO, or rare wine collection. Historically, who buys those?
Billionaires. Or massive sovereign wealth funds, people who don't look at price tags.
Precisely. The entry barrier is millions, sometimes tens of millions of dollars. The rest of us are completely locked out of that appreciation. We can't participate.
We can watch it on TV.
Right. Tokenization shatters that barrier. It breaks the asset down into tiny, affordable pieces. Platforms today allow entry for as little as $50. You aren't buying the whole building, you're buying a fraction of it. It democratizes access to wealth creation vehicles that were previously gated communities.
Okay, but is that actually a good thing? I mean, does a regular person need to own 0.00001% of a skyscraper? Or are we just finding new ways to extract money from retail investors by selling them the scraps that the rich people don't want?
That is the cynical view, and honestly, it has some merit. You have to be careful. But look at the data on portfolio performance. Ultra-high net worth individuals have always allocated a huge chunk of their wealth to private markets, private equity, art, real estate.
The so-called alts or alternative investments.
Exactly. The average person is stuck with public stocks and bonds. Fractionalization allows a regular investor to build a portfolio that looks a little bit more like a billionaire's, just on a micro scale.
So it's about diversification, not just the cool factor of saying you own a piece of a Picasso.
It's about access to uncorrelated assets. If the stock market crashes, your rare whiskey token might still go up. It gives you a different kind of risk exposure that was impossible to get before.
Okay, I'll buy that. So that's pillar one, fractionalization. What's number two?
The second pillar is liquidity. This is the big one for asset owners. This is the one that promises you can sell your house as easily as selling a share of Apple.
Which sounds like a fantasy.
It does. Because real estate is notoriously illiquid. We call it the liquidity discount. If you own a house and need cash today, too bad.
Good luck.
It takes months to sell. You have to stage it, list it, negotiate, go through escrow, inspections. It's a nightmare.
And expensive. Agents take their cut, closing costs, inspections, repairs. It's a huge financial drag.
Right. But if you own a token representing that house, you could theoretically list it on a secondary market and trade it instantly, 2047, to a global pool of buyers. You unlock the liquidity premium, that's the extra value assets get, simply because they're easy to sell.
Theoretically is doing a lot of heavy lifting in that sentence.
It is, and we need to be very honest about that later on when we talk about the risks. The liquidity isn't magic, but the potential is there to turn a frozen asset into a flowing one.
Right. And the third pillar, you said it was the boring one.
It's the boring one that excites the bankers at Goldman Sachs the most. It's operational efficiency.
The plumbing.
The plumbing. Smart contracts automate everything. Take a rental property. If you own a token for it, the smart contract can automatically collect the rent from the tenant's wallet, deduct expenses for maintenance, and distribute your share, say 5 cents, directly to your digital wallet every single day.
So no property manager writing paper checks. No one reconciling spreadsheets at the end of the month.
None of it. No administrative middleman. The code is the middleman. Some estimates in the industry say this cuts compliance and admin costs by up to 90%. That is a massive saving.
90%.
When you remove the friction of administration, you increase the yield for the investor. It's that simple.
Yeah.
It makes the whole operation leaner and more profitable.
That is huge. So we have cheaper access, potentially faster selling, and automated management. But I have to stop you here because this all sounds very cloud computing, very abstract. If I buy a token representing a house, do I own the brick? Can I go drill a hole in the wall to hang a picture?
That is the most common misconception. And the answer is almost always no. You do not own the brick.
Okay, let's unpack this because I feel like this is where the crypto magic runs into a brick wall called reality. If I don't own the brick, what did I just buy? What do I really have?
You usually own a share in a company that owns the brick. This is where we have to talk about the legal wrapper.
The legal wrapper.
Because here is the reality of 2026. Land registries, for the most part, do not read blockchains. You cannot walk into a county clerk's office in Ohio, show them your digital wallet on your phone, and say, update the deed, please.
They'd probably call security.
They absolutely would. The legal system relies on paper, stamps, and signatures. It moves at the speed of government. So to bridge this gap, the industry relies on the SPV structure.
A special purpose vehicle.
Special purpose vehicle. It sounds like a military transport, but it's just a company. A very boring limited liability company, an LLC.
So how does it work? Walk me through it.
Okay, picture a box. You take the physical asset, the apartment building, and you legally put it inside the box. So you create a new LLC, and that LLC purchases the building. The LLC now owns the deed. That's the real world part. It looks exactly like traditional real estate ownership.
Okay, so the LLC owns the building. My name isn't on the deed anywhere.
Correct. Then the second step is you slice up the ownership of the box into tokens. The tokens represent shares or debt in that SPV.
So I own stock in the company, and the company's only asset is the building.
Correct. And this is vital because it provides legal protection. It creates a liability shield. If the building burns down or a tenant sues because they slipped on ice, they sue the SPV, not you personally. Your risk is limited to your investment.
But this still feels like a workaround. It feels like we're just recreating the old financial structures on top of a new technology. If I hold the token, I own a share of the LLC. But who holds the keys to the house? Who makes sure the roof isn't leaking? Who is actually collecting the rent and paying the taxes?
That is the multi-million-dollar question. And that is what we call counterparty risk or manager risk. You are trusting the manager of that SPV to actually do their job.
So if the manager is incompetent or a crook, my token doesn't matter.
If the manager decides to stop collecting rent, or if they embezzle the maintenance fund and flee to a non-extradition country, your token on the blockchain might still say you own the house. But in reality, you own a share of an empty, crumbling shell.
So the blockchain record is immutable. Nobody can change the fact that I own the token. But the link to the physical world is fragile. It's based on trust.
Fragile and entirely dependent on human law and human honesty. That token is essentially a claim check. Think of a valet ticket at a restaurant.
Okay.
The ticket proves you own the car. The number on it is unique. But if the valet crashes the car or steals it, holding that little paper ticket doesn't help you drive home. The token is the claim, not the asset itself.
That is a terrifying but very, very helpful analogy. So the technology, the blockchain, is just the ledger. It's keeping score. Who is actually running this tech stack? What platforms are we seeing this built on? Is it still all just Ethereum?
Ethereum is still the backbone, yes. It has the most security and the most liquidity. But the landscape has really shifted in the last couple of years. We are seeing specialized chains, layer 2s like Polygon and Avalanche, being used for scalability because gas fees on Ethereum can still get high, especially for small transactions.
It doesn't make sense to pay a $20 fee to collect 5 cents in rent.
Exactly. The economics just don't work. But the really interesting development is the rise of chains like Polymesh.
Polymesh, that sounds like a fabric.
It's a blockchain built from the ground up specifically for regulated assets. See, on Ethereum, anyone can hold a wallet. You, me, a guy in North Korea, a bot.
It's permissionless. That's the whole ethos.
Right. But for securities, and let's be very clear, these real estate tokens are securities. That's a bug, not a feature. You can't legally sell a share of a U.S. building to a sanctioned individual. It's illegal.
Right. Your compliance department would have a heart attack.
Polymesh solves this by baking identity into the chain itself. You literally cannot hold a token on their network unless you have passed KYC Know Your Customer checks through a verified entity.
So the blockchain itself acts as the bouncer at the door. It checks your ID before it lets you in.
Exactly. It's not a compliance officer checking a spreadsheet after the fact. The code itself says access denied if you aren't verified. That is a massive leap forward for institutions who need to stay on the right side of the law.
Okay, so we have the structure. The asset goes in the box, the SPV. The box is tokenized, and the blockchain keeps score, sometimes with a bouncer. Now let's talk about what we can actually put in the box. We mentioned real estate, and looking at the landscape in 2026, real estate is still the heavy hitter, right?
Absolutely. It is the largest asset class in the world, something like $300 trillion globally. It's the one being tokenized the most aggressively. Projections suggest this market segment alone could hit $4 trillion by 2035. It's where the most activity is.
And it's not just theoretical anymore. We have platforms like Lofty and Realty that have been running for a few years now, so we have some real-world data.
Right. Lofty's a great example. They built on the Algorand blockchain. They allow users to buy tokens of specific rental houses. You can browse properties, see the inspection reports, and get daily rental income sent to your wallet. It's incredibly granular.
And what's interesting about them is the governance aspect, right? They use a DAO.
Yes, a DAO LLC structure. DAO being a decentralized autonomous organization.
So the token holders actually vote?
That's the idea.
Wait, hold on. So if I own $50 of a house in Ohio and the roof starts leaking, I get a push notification on my phone asking me to vote on which roofer to hire.
Essentially, yes. You vote on major repairs, you vote on rent increases, you might even vote on whether to evict a non-paying tenant.
That sounds exhausting. Honestly, do I really want to be a micro landlord for a $50 investment? I thought the point was to make this passive.
That's the critique. And it's a valid one. Some people love the control and the sense of ownership. Others just want the yield without the headache. It shows that ownership can be active even at a tiny fractional level. Different platforms are taking different approaches.
And then you have the big commercial stuff, the St. Regis Aspen Resort. That's the classic example everyone cites from the early days.
That was a pioneer project back in 2018, I believe. They raised $18 million by selling nearly 19% equity via Aspen coins. It turned a high-status luxury hotel into a tradable asset. It proved the concept worked for luxury commercial real estate, not just single-family homes in Cleveland.
And the scale is increasing.
Dramatically. More recently, we've seen Project Chanfleury in Canada, a $300 million tokenized funding project. And platforms like Blockholm in Luxembourg are letting people invest starting at €1,000 with a huge focus on regulatory compliance from day one. The scale is ramping up.
I noticed something really interesting in the notes about Dubai. It seems like they are trying to leapfrog the whole SPV complexity we just spent all that time talking about.
Dubai is the exception that proves the rule. They're trying to innovate on the legal layer itself. Most jurisdictions require that SPV wrapper, that legal box. But the Dubai Land Department and their Virtual Assets Regulatory Authority, or VAAR,
right?
They've been working on frameworks where the token might actually represent direct ownership on the deed.
So skipping the company layer entirely, the token is the deed.
Ideally. That's the holy grail. It's an incredibly ambitious goal. They want the blockchain to be the land registry. Not just a shadow ledger. It's not fully there yet, but they are closer than anyone else.
And is it working?
We saw a huge proof of concept in mid-2025. There were 2 luxury property sales in Dubai that were tokenized and sold out in minutes. Minutes. 2 buyers from 35 different countries.
Yeah.
And here's the key statistic. 70% of them had never invested in Dubai real estate before.
Wow, that is the power of global access. Selling a multi-million-dollar building in minutes to people who have never even set foot in the country. It's impressive, but it also feels a little detached.
It is detached. It's purely a financial transaction. There's no emotion in it.
Which brings us perfectly to the passion economy. I'm talking about art, whiskey, cars, collectibles. This is where tokenization gets colorful, and honestly where I get the most skeptical about the whole thing.
This is the luxury and collectibles segment. And it's booming precisely because these are assets that people emotionally connect with, but financially couldn't access. It taps into that desire.
Let's take art. Masterworks is the giant in this space. They have, nearly $1 billion in assets under management now?
Over 900 million? Yeah. Their model is really interesting. They are very selective. They buy what they call blue chip art. I'm talking Banksy, Picasso, Warhol. The big names. They hold it for 3 to 10 years and then they sell it at auction.
And the returns can be great. The notes mention a Banksy Mona Lisa print that saw a 32% annualized return for investors. That's a fantastic number.
It is.
But here's my issue. If I buy a token for a Banksy, I can't hang it on my wall. I can't show it to my friends at a dinner party. It's sitting in a climate-controlled warehouse in Delaware that I'll never visit. So if I can't look at it, am I really an art collector, or am I just speculating on a graph that happens to be attached to a piece of art?
That is a completely fair critique, and it's a philosophical one, but let's flip it. Historically, who got to make money when that Banksy appreciated 30% in a year?
The guy who could afford the $3 million price tag to begin with?
Right. The wealthy gatekept the entire asset class. Masterworks would argue that they are simply unlocking that return profile for the rest of us. They aren't selling you the experience of art, they're selling you the financial performance of art.
So it's the pure commoditization of culture. It turns a Picasso into a stock ticker.
In a way, yes. And you have to be aware of that going in. And notice the fee structure, because it tells you exactly what kind of business they're in. It operates very much like a hedge fund.
What's the catch? What are the fees?
It's usually a 1.5% annual management fee to cover storage, insurance, and administration. Plus, and this is the key, they take 20% of the profits when the art is sold.
The classic 1.5 and 20 model from the hedge fund world.
Exactly. So if that Picasso doubles in value, Masterworks keeps 20% of that upside. It aligns their incentives with the investors, but it's a significant chunk of change you need to factor in.
There was another example in the art and music world that I loved because it was so specific, and it really gets at the nuance here. The Rihanna NFT.
Ah, yes. The bitch better have my money drop. This was fascinating because it highlights the difference between owning the thing and owning the rights attached to the thing.
Right.
They sold 300 NFTs related to the song, But the token didn't give you copyright ownership. You didn't own the master recording. You couldn't use in your own movie.
So what did you get?
You got a right to a portion of the streaming royalties, specifically 0.0033% of the royalties per token. So every single time someone streamed that song on Spotify or Apple Music, the token holders got paid a tiny fraction of a cent.
It turns a pop song into a yield-bearing asset. You're basically buying a micro-annuity.
Exactly.
Yeah.
It separates the economic rights from the intellectual property rights. And you can see that model being applied to everything from movie rights to pharmaceutical patents.
Speaking of liquid assets, let's talk whiskey. Because I love whiskey, but this seems weird to me. Tokenizing a cask of scotch.
Whiskey is a surprisingly strong performer as an alternative asset. Rare whiskey has outperformed gold and even real estate in some indices over the last decade, up something like 580%.
That is just insane.
It is. But whiskey is heavy, it's fragile, and it's hard to store properly. You don't want to buy a 500-liter cask and try to keep it in your garage.
No, I'd probably drink it. Or drop it. Or both.
Exactly.
Yeah.
So platforms like CashCoin or BlockBar solve this logistical nightmare. You buy a token representing a specific identified cask or a rare bottle. The physical liquid sits in a secure, insured, climate-controlled warehouse in Scotland, aging and hopefully gaining value.
Can I just hold the token?
You hold the token. If you want to sell your investment, you sell the token on their marketplace. You never have to touch or ship the actual bottle.
But you can redeem it, right? If I decide I want to drink my investment for a very special occasion.
Usually, yes. That's the redemption feature. If you hold the whole token, you can burn it, which means destroy the digital token, and the platform will ship you the physical bottle. But most investors treat it purely as a financial instrument.
And then there are cars. Ferraris, Lamborghinis. Platforms like Curio Invest allow you to own a piece of a supercar.
Which sounds incredibly cool, but again, we run into the Masterworks problem. You can't drive it.
Right, I can't take my 1% of a Ferrari F40 for a spin on the weekend.
No, it sits in a vault in Switzerland or Germany, kept in pristine condition. You are betting solely on the appreciation of the vehicle as a collector's item. It strips the utility and the joy away and leaves only the financial value.
Which brings us to the biggest, perhaps driest, but maybe the most lucrative category of all, financial instruments. We're talking treasuries, bonds, private credit. This is where the institutions are playing.
This is the institutional play, 100%. In 2024 and 2025, high interest rates drove a massive migration of capital on-chain to capture yield. We saw the rise of tokenized treasury funds.
So what is that exactly?
Basically, investors and now institutions realized they could hold a token that represents ownership in a fund that holds U.S. Treasury bills. So you get the safety and the 5% yield of T-bills, but in the form of a liquid, 247 tradable tokens.
So you can use it in other ways.
That's the key. You can use that token as collateral in DeFi protocols. You can lend against it, you can trade with it. It's putting your money to work twice.
You're earning yield on the treasury, and you're using it as capital elsewhere.
In a sense, it's taking the safest asset in the world, U.S. government debt, and giving it the speed and velocity of crypto. This is where companies like BlackRock and Franklin Templeton have moved aggressively. They aren't doing this for the cool factor. They're doing it because it makes the plumbing of the financial system faster, cheaper, and more efficient.
That's a perfect transition to the regulatory landscape. Because you mentioned BlackRock, and they do not move a muscle without an army of lawyers giving them a green light. We are in 2026 now. How has the law caught up to all this? Because for a long, long time, it felt like the Wild West.
It's night and day compared to a few years ago. The biggest shift has been the move from the question, is this legal? To how do we comply? The industry has matured past the denial phase.
So in the US, what's the verdict? Is a tokenized piece of real estate a security?
In the US, almost certainly yes. We still use the duck test, the Howey test from the 1940s. If it looks like an investment of money in a common enterprise with an expectation of profit from someone else's work, it's a security.
And a token for a rental property is quacking like a security.
Exactly. It's cracking very loudly. And because of that, most US-based projects have to use exemptions from standard registration. Regulation D and Regulation S are the most common.
And what do those do?
These are rules that say, okay, you can sell this security without a full public IPO, but only to accredited investors, which is a legal term for wealthy people, or to people outside the US. That's why you so often see that banner, US retail investors not allowed, on many of these token platforms.
They're trying to stay within those safe harbors. But Europe is different, right? They've taken a more comprehensive approach.
Europe has MiCA the markets and crypto assets regulation. It's fully in effect now across the EU, and it's a proper bespoke rulebook for crypto. It distinguishes between different types of crypto assets and transferable securities.
So it creates categories.
It creates clarity. If your RWA token is deemed a transferable security, it falls under the old rules. MiFID II traditional financial regulation. If it's a utility token or stablecoin, it falls under the new MiCA rules.
Yep.
That clarity is why Europe has seen so much innovation and so many projects setting up shop there. They know the rules of the game.
And we have some new legislation here in the US too, finally. The notes mentioned the Genius Act. I still love that name.
Congress does love a good acronym. The Genius Act of 2025 was a game changer, but specifically for stablecoins. It established that stablecoins must have 100% cash or cash equivalent reserves. It took the risk out of them.
Why does that matter so much for real-world assets? They seem separate.
Because you need a reliable, stable currency to settle the trades. If I sell my real estate token worth $1 million, I want to be paid in something that I know will be worth $1 million tomorrow, not something that might fluctuate 20% in an hour.
You need a stable unit of account.
The Genius Act gave institutions the confidence to use stablecoins like USDC for settlement. It basically said, okay, these digital dollars are backed by real dollars. It was a foundational piece of the puzzle.
And there's the Clarity Act moving through Congress now, expected in 2026.
Right, and that's the big one. The Clarity Act aims to finally standardize the definitions of what constitutes a digital commodity versus a digital security. It's trying to finally end the turf war between the SEC and the CFTC over who regulates what. This regulatory certainty is the green light for the big banks. It removes the gray area fear that kept compliance departments awake at night for years.
So regulation is firming up, the tech is working. What are the big trends we are seeing right now in early 2026? Where is this all heading in the near term?
Well, the biggest trend is undeniably institutional domination. It's not just scrappy startups anymore. It's Goldman Sachs, it's JP Morgan with their Onyx platform, it's BlackRock. They are building the rails for this new financial system.
So they're not just using the technology, they're becoming the infrastructure providers.
Exactly. We are seeing banks acting as crypto intermediaries and custodians. You might log into your Chase or Wells Fargo app in the near future and see a digital assets tab right next to your checking and savings accounts.
That's wild, the complete normalization of it.
It's the final step. Another massive trend is interoperability. For a long time, blockchains were islands. If your real estate token was issued on Ethereum, it was stuck there. You couldn't move it.
A silo, just like the old bank accounts.
A new kind of silo. Now, with protocols like Layer 0 and Axelar, we are seeing effective cross-chain messaging. You might own a token on the Polygon network, but use it as collateral in an application running on Solana. The walls between these digital nations are coming down.
And AI. I feel like we can't have a conversation in 2026 without mentioning AI's role in all this.
It's inevitable. It's becoming deeply integrated. We are seeing AI used for predictive analytics on asset pricing. Imagine an AI that analyzes satellite imagery of a neighborhood, local economic data, foot traffic patterns, and sentiment from social media to help price a tokenized house in real time.
Dynamic pricing for real estate.
On a minute-by-minute basis. It's also huge for automated risk management in tokenized portfolios. An AI could automatically rebalance your RWA holdings based on thousands of data points far faster than any human could.
I want to circle back to something technical because it seems to be the linchpin of this whole 2026 institutional resurgence. We keep seeing this term in the notes. ERC 3643, it sounds like a droid from Star Wars. Why does this specific token standard matter so much?
It's absolutely critical. It's the difference between permissionless crypto and permissioned finance. Think about Bitcoin or early Ethereum. If I want to send you money, I just need your public address. I don't know who you are. You could be a saint or you could be on a global sanctions list. The code doesn't know and it doesn't care.
Which is an absolute nightmare for a regulated institution like JP Morgan.
It's an instant go-to-jail card for their compliance officers. They cannot touch an asset if they don't know who's holding it, who it's being sent to, and who owned it before. They need a chain of custody.
So how does this ERC 3643 solve that?
It solves it by baking the identity check and the rules into the token itself. It's a smart standard.
How does that work in practice? Let's say I own a tokenized bond and I want to sell it to my cousin. What happens?
Okay, so when you go to your wallet and hit send, the token essentially wakes up and asks a series of questions before it moves. It might ask, is the receiving wallet on an approved whitelist? It will ask, does the person receiving this have a valid, up-to-date KYC Know Your Customer passport from a trusted identity provider?
And if my cousin hasn't uploaded his ID to the system or he lives in a restricted country?
The token literally refuses to move. The smart contract will reject the transaction. It's not that the bank's server stops it, the code of the blockchain stops it. The transaction fails. The blockchain itself says access denied. This is crucial. You cannot have a terrorist financing organization owning shares in a Manhattan skyscraper. ERC 3643 enforces the law at the code level, automatically.
It sounds perfect, almost too perfect. And you know me, I get suspicious when things sound too good to be true. We have spent all this time on the promise. We have to look at the risks. What are the gotchas? What goes wrong here?
There are significant risks, and they are almost never about the blockchain code being wrong. They are about the messy human bridge to the real world. The biggest one is what's called the Oracle problem, or the physical disconnect.
Give me a scenario. What does that look like?
Let's say you own a token backed by a gold bar in a vault in London. The blockchain immutably says you own token number 123, which corresponds to gold bar number 123. The token is perfect. But what if the vault manager is corrupt? What if they sold the real gold bar and replaced it with a gold-painted lead bar?
The blockchain cannot see inside the vault.
Exactly. The blockchain is a system of truth about the token, but it is completely blind and ignorant about the asset. It relies on trusted humans or oracles to tell it what's happening in the real world. If the physical asset disappears or is compromised, the token becomes worthless, even if the code is perfect.
So the token is only as good as the legal and physical enforcement behind it. The auditors, the custodians.
All that boring real-world infrastructure is still absolutely essential. A token is a claim check, and if the courtroom burns down, your check is useless.
That is a massive point. The digital twin can live on forever, even if the physical twin is dead and gone. What else?
We also have the liquidity illusion. This is a huge one. Just because a token can be traded 24/7 doesn't mean there is a buyer for it at 3 in the morning on a Sunday.
Right. If I want to sell my fraction of a niche painting during a recession, I might find the market is a complete ghost town. There are no bids.
Exactly. Secondary markets for many of these assets are still very immature. You might face a massive spread, a huge difference between the buying and selling price. Or you might just be stuck with the token until the platform decides to sell the entire artwork years later. Liquidity has to be earned. It's not a feature you just turn on.
And custody risk. What happens if the platform itself goes bust?
This goes back to the SPV structure. If the platform that created the token goes bankrupt, and we've certainly seen plenty of crypto platforms go bankrupt over the years, what happens to the asset in that SPV?
You'd hope the SPV is safe since it's a separate company.
Technically, it should be bankruptcy remote. But in a messy legal battle, with creditors crawling all over the company, token holders might find themselves in a long line. You might be considered a general creditor. You might spend years and a fortune in legal fees trying to prove that your token gives you a direct claim to the underlying building.
It's a sobering reality check. It's not magic internet money. It's still finance, with all the messiness of human error and legal complexity attached.
And we can't ignore regulatory fragmentation. A token might be structured as perfectly legal in Switzerland or Singapore. But if you, a Swiss citizen, sell it to a U.S. retail investor without the proper licenses, you have just broken U.S. securities law. The internet is global, laws are local, that friction hasn't gone away, and navigating it is incredibly complex.
So as we wrap this up, let's try to synthesize this whole massive topic. We are looking at a world where dead capital, these frozen illiquid assets like buildings and art and infrastructure, is being systematically turned into live capital.
That is the core transformation. That's the big promise. We are unlocking trillions of dollars of value that was previously stuck. It's the bridge between the Wild West of early crypto and the stable, tangible wealth of the real world.
It's a brave new world for sure, but I want to leave the listener with a thought that really struck me while reading about the tokenization of everything. We are heading toward a reality where everything could have a ticker symbol. Your house, your car, your watch collection, maybe even a share of your future salary.
It's the ultimate financialization of daily life. Everything becomes a tradable asset.
Exactly, and my question is, as we financialize everything, as we put a price ticker on every aspect of our lives, do we lose something? Do we lose the intangible value of simply owning and enjoying something rather than constantly watching its price chart on a screen? If my home is just a graph of token prices fluctuating day by day, is it still a home?
That is the philosophical question for the next decade, isn't it? When everything is an asset to be optimized, does anything remain just a possession to be cherished?
Something to mull over as you check your portfolio. That's it for this deep dive.
See you in the next deep dive.